Hi, I'm Mike Ward. There's been a lot of talk in the press recently about short selling, and I thought it would be a good time to explain to you how all of this works. So let's dig in a bit. First of all, we've got to master some of the terminology. There's quite a bit, I'm afraid. But you'll be familiar with talking about buying and selling shares. That's easy enough. But we've got to kind of move from that to long versus short. I'll explain. So let's assume that I own no Standard Bank shares and I want to go into the market and buy 100 of them. And if the price is also 100 Rand, you can see my cash flow is going to be minus 10,000 Rand. And on day naught, I will be long in the market because I now own Standard Bank shares. And if I'm correct after a couple of days or weeks, and the share price goes up to 150 and I sell my shares, I will be able to get a cash flow of 15,000 and make a profit of 5,000 Rand. Now, that's obvious. Everybody is familiar with those terms. And so what about if I want to sell the shares? If I own them, like I've done now, it's simple. I can just exit. I can close off my position. But it's very handy to be able to actually sell something and that you don't own. So let's have a look at how that would work. So assume again, I own no Standard Bank shares. And what I'm going to do though, is I'm going to go and sell 100 Standard Bank shares. And where am I going to get them from? That's the obvious question. We'll deal with that in a second, but I'm going to show you that it's possible to borrow them. You can borrow a friend's car and you can charge a bit of, or charge them a bit of rent if they borrow your car, let's say, and if they then bring you back your car, you're kind of happy. But what if they bring you back a similar car? That's the problem. So we will talk about that in a second. So we're going to go and borrow these shares and we're going to sell them. And we're going to see a cash flow of plus 10,000. That's really cool. And if you're a hedge fund, you're going to take that and you're going to actually go and buy some shares with that. But we'll talk about that at some other stage. So if we're right, and over the next few weeks, days hopefully, Standard Bank share price does actually fall to 50, we're going to close off our position. We will be out of the market. We will have to buy back our shares, but it will only cost us 5,000 because the share price halved. And you can see we've made a nice profit when the share price went down. So the beauty of this is that it's possible to make money on both sides of the deal. If you think Standard Bank's can go up, then you buy it. If you think it's going to go down, you sell it. And if you don't have shares, you short it. And so it kind of doubles your opportunity set on the market. That's very handy. So how is it possible, though, to sell something you don't own? Well, in financial markets, you're going to see that quite a lot of this happens. There are lots of borrowers, usually hedge funds, and there are lots of lenders, usually institutions, pension funds. And we're going to use another word. We're going to talk about scrip lenders. So you'll hear us talking about scrip shares. And but a key thing about all of this is that we have to introduce some more language to you. The assets in question have to be what we call fungible. Now, many things, most assets in life are not fungible. Cars, for example, are not fungible. You would not be happy to get back a similar but not the same car if you'd lent it to a friend. Similarly, you can't just swap houses. One house is unique, it's different. And jewelry tends to be kind of very special. And wives are certainly not fungible. You can't swap them. So, but commodities like sugar and sometimes certain other things like iron ore or pork bellies can be what we call fungible. And you don't really need to get the same grains of sugar back. Sugar is sugar. And within certain kind of limits. Cash is also fungible. You don't need to get the exact same $100 note with the same set of numbers on it as you lent. Any $100 note will be fine. And shares are the same. Scrip is the same. It doesn't have to be the same Standard Bank shares. It just has to be Standard Bank shares. So this gives us a lot of opportunities in financial markets. So the lenders are typically pension funds who have got a long-term positive view on the share. So they own Standard Bank, let's say, and they believe that in the next 10 years, Standard Bank is going to be a good long-term position to hold. They're not too concerned about what happens in the short term, but they wouldn't mind making a little bit of commission by lending out their shares. They are a bit concerned because they know what you're going to do. You're going to go and sell these shares if you go short. So they will have to think about that. We'll come to that in a second. And the borrowers are hedge funds who clearly have got a short-term view and they want to short the share. They think maybe they know something. Maybe they know this. They don't believe the financial statements. Maybe they think there's corruption or problems or fraud or who knows. But they've got a short-term view and they want to take the opposite position. So that gives us a market. And there are some issues though. First of all, who facilitates this? Because we need market makers. And in this case, it's what we call prime brokers. These institutions take on this role. They're the ones who match buyers and sellers, but in particular, they manage the risk. And they have to be careful about this because obviously the pension fund is going to want some collateral. They're not going to lend you 100,000 Standard Bank shares knowing you're going to go and sell them and make a whole lot of money without making sure that they've got you. And so this is managed by a mechanism we refer to as mark-to-market on a daily basis, sometimes even intraday, within the same day. And so that's the role of the prime broker to set that up and to manage it. We'll have a look at how it works in a second. But there are other issues. What if Standard Bank pays a dividend? Well, the lender, the pension fund, would want that dividend. But now those shares have been sold by the hedge fund to some other buyer, and he or she gets the dividend. So usually in the agreement, the hedge fund, the short seller, has to make good the dividend and pay that to the pension fund. And whatever Standard Bank pays as a dividend, the pension fund wants to see that. Now, it's a bit complicated because it's not actually a dividend, and there'll be some tax issues because dividends are taxed at different rates to sort of payments, capital payments, and so on, but we can sort that out. The bigger issue is voting rights. If the pension fund wants to go to the annual general meeting to complain about how much the directors are paying themselves or strategy or whatever, it's going to find that when it gets to the door, it doesn't own any shares. And those shares are now registered in someone else's name, and that person is deciding strategy. So that's a limitation. There's nothing we can do to fix that. So let's have a look at how this mark-to-market would work. Now, what's going to happen, let's assume at the end of day naught, we short Standard Bank shares, or the hedge fund does. And so you can see they've shorted 1,000 shares at 100 Rand. And so the value of the short position is minus 100,000 Rand. And the hedge fund's cash flow is going to be minus 1,000. That's just the starting position. That's what we call the margin. They have to put that into a margin fund, which is held by the prime broker. Excuse me. Now, at the same time, you can see that the margin account, I'm just showing you there, I'm sitting at 10% of the value of the deal. Now, that 10% is just a nominal number that I put in there. It'll be around about that, sometimes a bit less and sometimes a bit more. Depends how volatile and fast Standard Bank's shares are moving in the market. And that can go up or it could come down. But they'll have to put up a margin. Similarly, the pension fund will also have to put up a margin on this so that it can be managed on a day-to-day basis. Every day we're going to cancel and close out these positions, make sure that if the share went up, the one wins, and if it went down, the other wins, and so on. So at the end of day naught, there's no profit. But let's assume that, in fact, the share price of Standard Bank went up by 5 Rand at the end of the first day. Now, of course, the value of the short position is minus 105,000. So because the shares went up, the hedge fund who shorted this actually is in trouble. And so what's going to happen, no more cash flow is necessarily needed because they've got a margin account with the broker. But the value of their margin account is going to go down by 5,000 Rand. And you can see that that's what's reflected there. And that same 5,000 Rand is being moved to the pension fund's margin fund account. So that's sitting at 15,000. And if you're working out the profit or loss to the hedge fund, they lost effectively 5,000 Rand on that day because the share price went up. If on day 2 it goes up by another 10 Rand, well, now what happens is that the hedge fund is in even more trouble. It needs to find another, it lost 10,000 Rand. And it's going to receive a call from the broker halfway through the day. We call that a margin call. Usually before it gets to, the account gets to 0, and they'll have to top up their margin account. And let's say they put in 15,000. So I'm showing a cash flow. I'll put a call sign there. And at the end of the day, their margin account is now actually, they put in 15,000. So their margin account is going to be sitting at 10,000. And effectively, you can see they've lost 15,000 in total. They've put in a total of 25,000 and they've lost 20,000. So they are showing a loss here. The pension fund, on the other hand, has received that extra 10,000, and in their margin account is actually 25,000. They could draw that down again if they wanted to, but they're probably going to wait a little bit in a volatile market. On day 3, let's hope that the share price reverts back to, let's say, 100. And now what happens is the pension fund's margin account is debited by 15,000, and that goes across to the hedge fund's account. And so they're now sitting, and their margin account is sitting at 25,000. Let's say on day 4, the share price keeps going down and drops to 90. So now what's happened is that the hedge fund has made another 10,000, and they're going to close out their position, and they're going to sit with a profit of 25,000 Rand in total. And sorry if I got that right. Actually, sorry, 10,000 Rand in total. Yeah, that's right, because they sold at 100 and they can buy back at 90. And you can see the hedge, this is their margin account, which I'm just showing you, balances out to plus 10,000 Rand. And you can see what's happened essentially is the pension fund's margin account has dropped to 0. And that is what is the profit that's gone through to their 10,000 deposit has gone through to the hedge fund. So that's kind of how it works on a day-to-day basis. The risk is managed. Now you can see from this that we're never putting up the full amount. And this leads us to some interesting scenarios. How is it possible, for example, to be short more than 100%? That would mean all the shares have been lent and borrowed and shorted. And sometimes you see that. Well, you see, once again, with financial markets, what we were doing just back there on the earlier slide shows you that it's possible to kind of do this with an index. And so we have to talk a little bit about derivatives. Now, derivatives are just financial instruments like futures, single stock futures, or options, which are a little more complicated, but they are called derivatives because they derive their value from the underlying share. They themselves just reflect a value based on the movement of that share. So we are using the share index rather than the share price to measure value. And that's pretty much exactly what we were doing in the previous slide. So the other part of this, though, is that it's possible for you to go long on an index. And what will happen is now we don't really need to have a pension fund involved at all. We can have some people who are short, like we had, and we've got some other people who are long. And they may be institutions or individuals, doesn't really matter. And they're taking the place of the pension fund. And so it's just tracking an index, and we are matching the positions of longs and shorts. And that is interesting because also these positions are geared. So much like we saw before, they're only putting up about 1/10 of the value of the underlying contract that they've signed. And so they've got a lot of gearing. And this can be very dangerous. So we need to explore that a bit. Are shorts really dangerous? Well, actually, when you get into financial markets, it's all dangerous. You can lose 100% if you go long. If you go long on Standard Bank and Standard Bank tanks completely, well, you're going to lose 100% of your money. Now, usually you don't lose it all at once. Usually these things go bang and then they bleed for a bit. And you'll be familiar with some of those shares, no doubt. And so not 100% loss suddenly when you're long. Usually it's painful and then a bit more painful, but slowly. So just to illustrate this a little bit, to give you a sense of what it can be like, you'll see I cut this out the Wall Street Journal on the 22nd of September 2001. And you may remember that that is 1 week after 9/11, what the Americans call 9/11. And this is showing you what happened on the Dow Jones Industrial Average. Now, what happened was the stock market got closed after those planes flew into the Twin Towers. And they, in fact, were closed for about 4 days. And nobody could trade. But of course, there's all kinds of interesting news, all bad, coming through the financial press. And so markets are technically collapsing, but nobody knows how bad it is. And so when they opened on the Monday, they fell by 7.1% on 1 day. At that stage, that was the biggest one-day fall ever. Since then, we've had bigger ones in 1 day. And and I'm showing you, this is the Dow Jones average. I'll show you the S&P 500, which is probably a better index to look at. But I'm showing you as well, it didn't end after that day. On the Tuesday, the Wednesday, the Thursday, the Friday, shares kept on falling. So we can have events in markets which are very painful, even if you are a long owner, long in the market. But here's just showing you some crashes just to remind you that you can lose a lot of money by being long. And now we're looking at the S&P 500 here. And you can see, for example, the white line shows you what happened in October 1987. I remember it very well, Black Monday. And you can see a massive crash there in the S&P 500 on a single day, or just over a couple of days, actually. My market fell by more than 30% and then steadied out. You can see with the S&P 500 post-Lehman, that's the purple line here, you can see that in the space of a few months, the S&P 500 dropped by more than 40%. And that's very painful for anybody who's long in the market. And just showing you there what happened with Corona as well, just in the space of a few days there in earlier last year. In fact, the market S&P 500 also collapsed by more than 20% over a few days. So you can lose money if you're long. But if you're short, it's even worse. You can lose much more. Because let's say if Standard Bank share price goes up from 100 to 200 Rand, well, then you've already lost 100%. But it can keep going up. And if it goes to 300, you've lost 200%. And so it can be really bad. So GameStop went up by 1,600%. That is going to be extremely painful, especially if you shorted it right up front. So you would have to have very deep pockets to see your way through all of that. But so that's what we call a short squeeze. You've heard that term too recently. And you can stay short as long as you've got lots of money and you keep piling it in there and you keep meeting your margin call. But the minute you miss your margin call and you can't put up the money, the broker closes out the positions. You've lost whatever you've lost. And they've been taking your money every day, sometimes more than once in the day if the price is moving a lot. And sometimes they've increased the margin like they did, in fact, with GameStop. You have to put up more than the 10%. And so it can be a very rough ride. And so if we look at the GameStop fiasco, just in closing, there are a lot of questions about whether this was really illegal market manipulation, because that is illegal. Is this really democratization of markets? Is it true that this enabled small players to get into what is usually an institutional market within big institutions and hedge funds and so on? Well, investors have always been able to get into the market on a small scale if they want to. Didn't really change that. But it certainly hit some big hedge funds. They took huge hits. Melvin Capital, Two Sigma, David Shaw, all big hedge funds lost money. But in the long term, actually, the biggest losers are going to be the retail investors who shorted. And the reason for that is that this is no more than a Ponzi scheme. The people who make a lot of money on these deals, like all Ponzi schemes, are the people who get in there up front first. They tell you to go and buy, they exit at some stage. They may not have made the full amount, but they probably made quite a bit of money. And the people who really lost a lot of money are the people who got in towards the end and then just saw their positions just melt down. So retail investors, and the reason for that is the intrinsic value of GameStop is very low, let's just say. It was well above what it was really worth. So these, the mechanisms of markets are there to ensure that the proper value eventually comes out. And it will. Over time, it will eventually, it is a market pricing mechanism. And if it's really got value, it'll come through in the long term. Standard Bank share may go up over the next 10 years. But if it isn't, and there's problems, the short sellers are going to find it, and they're going to make money out of this. I hope you found that interesting.